Do you remember that one time you heard about a friend, or maybe it was someone on TV, who made a killing in the stock market because they knew when to buy and sell? It sounded almost magical, right? Like they had a crystal ball predicting the future. But let me ask you something. How many times have you tried to time the market? Be honest. How did it go? Did you get rich, or did you watch your gains slip away? The truth is, for most people, trying to time the market is like trying to catch smoke with your bare hands. Impossible. And in this video, I'm going to show you exactly why that is. I'm Mo, and today, we're diving into one of the biggest myths in the world of investing: market timing. By the end of this video, you'll understand not only why it doesn't work, but also how you can approach investing in a way that actually sets you up for long-term success. Trust me, this one is going to save you a lot of headaches, so stick around. Imagine this. It's March 2020. The world is in chaos and financial markets are crashing. You're sitting at home, glued to your phone, watching headlines scream, "Market collapse." Stocks are down 30%, 40%, some even 50%. You start to panic. Should you sell everything now? Wait for the bottom to buy low? Or just sit there doing nothing? It feels like a game of musical chairs, and you don't want to be left standing when the music stops. Now fast forward a few months. By June, the market is skyrocketing again. If you had sold in March, you might have missed one of the fastest market recoveries in history. But if you held your nerve, you'd have seen those losses bounce back in record time. That's the problem with trying to time the market. It's not just about predicting when to get out. You also have to guess the exact moment to get back in. And let me tell you, it's nearly impossible to get it right. Let's be real. Market timing feels tempting. The idea of selling at the top and buying at the bottom, it's like hitting the jackpot in a casino. And honestly, it's not your fault for thinking this way. Everything around us, TV shows, news outlets, social media, glorifies those who seem to crack the code. But here's the catch. They almost never show you the full picture. They don't tell you about the countless times someone guessed wrong and lost big. Take, for example, that one person you heard about who got out before the 2008 crash. Sure, they look like a genius, but what happened after? Did they get back in at the right time? Or did they stay out too long, waiting for a better opportunity? History shows us that even those rare wins often end in missed opportunities and lower returns in the long run. Why is market timing so hard? The answer lies in human psychology. We're wired for fight or flight. When markets crash, the emotional part of our brain, the amygdala, screams, "Sell now!" And when we see stocks soaring, we feel the fear of missing out, FOMO, and want to jump in. These emotions are designed to protect us in life-threatening situations, but in investing, they're our worst enemy. It's also about control. We want to believe we have control over our financial future, but trying to time the market is like trying to predict the weather 6 months from now. Sure, you might get lucky once or twice, but consistently? That's a whole different story. Here's the truth. Missing just a few key days in the market can have a massive impact on your returns. Let's break it down. Over the past 20 years, the S&P 500 has returned about 7 to 10% annually. But if you missed just the 10 best days in that period, your returns would be cut in half. That's right, half. And here's the kicker. Those best days often come right after the worst days. So if you panic and sell during a crash, you're almost guaranteed to miss the rebound. It's like leaving the party right before the fireworks start. Let's look at two investors, Peter and Jane. Both start investing in 2005 with $10,000. Peter tries to time the market, jumping in and out based on news and predictions. Jane, on the other hand, invests her money and just lets it sit, adding more consistently over time. By 2025, Jane has significantly more wealth than Peter. Why? Because Peter's attempts to beat the market caused him to miss critical growth periods, while Jane benefited from the power of compound interest. Peter's story is a lesson for all of us. Every time he tried to outsmart the market, he was playing a game of chance, not strategy. And just like a gambler at a casino, the odds were stacked against him. Now, you might be thinking, okay, I'm not an expert, but what about the professionals? Surely they can time the market, right? Wrong. Study after study shows that even the pros, hedge fund managers, analysts, economists, fail to consistently beat the market. In fact, over 80% of actively managed funds underperform the S&P 500 over the long term. If the so-called experts can't do it, what makes us think we can? Take Warren Buffett, for example. He's one of the greatest investors of all time, and even he admits he doesn't try to time the market. His strategy is simple: buy quality investments and hold them for the long term. If it works for Buffett, why wouldn't it work for us? So if timing the market doesn't work, what does? The answer is simple but not easy. Stay invested. Focus on time in the market, not timing the market. This means sticking to a long-term strategy, ignoring the noise, and trusting that the market will go up over time. Yes, there will be ups and downs. But history shows us that over the long haul, markets recover and grow. This is where strategies like dollar cost averaging come in. By investing a fixed amount at regular intervals, you automatically buy more when prices are low and less when prices are high. It's a simple, effective way to take emotion out of the equation and let the market work for you. Before we dive into the next part, let me quickly remind you, if you're enjoying this video and finding it valuable, don't forget to hit that subscribe button. It's free, and it helps the channel reach more people like you who want to learn and grow their investing knowledge. Thanks for your support. Now, back to it. A lot of people think they can follow the so-called smart money, the hedge funds, the billionaires, the gurus on TV. But here's the thing, even they get it wrong. In 2008, during the financial crisis, some of the world's smartest investors lost billions trying to predict the bottom. Warren Buffett, one of the greatest investors of all time, famously said, "I don't try to time the market. I buy when I have the money and hold for the long term. If it's good enough for Buffett, it's good enough for us." Now, you might think, okay, if timing the market doesn't work, maybe I just won't invest at all. I'll wait until things feel safe. But here's the harsh truth. Waiting is the worst thing you can do. Inflation eats away at your savings, and the longer you stay out of the market, the more you miss out on compound growth. The best time to start investing was 10 years ago. The second best time is today. Take someone like Sarah, a teacher who started investing small amounts in her early 20s. She didn't worry about market timing. Instead, she focused on investing regularly, regardless of market conditions. By the time she reached her 40s, her portfolio had grown exponentially, all thanks to compound interest and staying the course. So what's the lesson here? Stop trying to predict the future. You don't need a crystal ball to succeed in the market. What you need is patience, discipline, and a long-term perspective. Stick to your plan, stay invested, and let time do the heavy lifting. Now it's your turn. What do you think about timing the market? Have you tried it before? And how did it go? Let me know in the comments. And if you enjoyed this video, don't forget to subscribe and turn on notifications so you never miss out on future tips and strategies. Thanks for watching, and until next time, happy investing.